All right. Well, welcome back. Uh, another weird Tuesday, I have to say. Maybe just seems that way because I'm writing the threes report on Tuesdays. I'm going to go through that and then hopefully give you something. We always like to under promise and over deliver. So I'm hoping that by bringing you sort of a snapshot, condensed version of what I presented at the Money Show last week. Uh, which is called The Case for Simpler Investing. Maybe it'll spark some ideas. All right, let's start with what you should see in front of you. I always like to confirm because I'm not Mr. Technology, especially when it comes to presentations. But you can see the threes report here, right? Which we sent out, maybe about an hour or two ago, I guess an hour ago. And somebody confirm for me, you can see that on my screen, so I know I'm sharing the right one. Beautiful. Okay, thank you. All right. So, I didn't really make the James Bond reference here, but you probably got it. A lot of us are about that age. Bonds, treasury bonds. Not the first time I've used it. Didn't feel like being original today. So, obviously, we do this in a couple of formats now. If you haven't noticed, the threes report is getting bigger, longer, and just packed with a lot more content. It really is more me kind of pouring as much as I possibly can into it. And as you will note, we've got another uh, additive feature to it, which I'm probably going to put out for the first time tomorrow and then maybe make it a Monday thing, which is a little more trading oriented, but it's also intended to help you all get used to looking at charts the way I do. I've thought so much about how I could transfer that part of my knowledge. And a lot of it is simply just getting repetitions, getting reps, like going to the gym or playing a sport or studying for a test. Okay, so like I said, stock market's gone full casino here, but there was a time where I was, maybe if I held something for 3 to 6 months, that was a fairly short time horizon or evaluation horizon, as I like to call it. But that's changed. I mean, it's a trader's market to the extent that you want it to be, but that does not mean you're all in or all out. We're playing offense and defense at the same time, uh, and you want to have that escape hatch because I don't know when things are going to bust. I just think that there's a good chance they will. Uh, I'm thinking a lot about treasuries. That's why the title was what it was. I have never been more excited about owning a bond ladder containing zero coupon treasuries. And I'm not going to stop yapping about it until a lot of my baby boomer and Gen X peers, I'm kind of on the borderline there, until more of them at least have heard that case. I'll be writing more about it, etc. And the reason that I love a zero coupon treasury bond ladder, particularly with bonds kind of in that 10, 15, 20-year range, is that really one of three things can happen after you set it up. Okay. I'm not doing it for the annual income. I'm doing it for the certainty or the virtual certainty, if you believe the government will pay us, even if it's inflated dollars down the road. But to be able to say, okay, I'm going to have a certain amount of money coming due every single year on dates that I choose now. And I'm effectively going to fund that by paying some number of cents on the dollar. So if it's 10 years out and it's, I don't know, maybe 70 cents on the dollar, I invest $700 now and I'll get 1,000 back, or I can do it in multiples of that. So to me, I've set it up so that come heck or high water in the stock market or in my life, even if it's beyond my life, uh, Dana and our adult children and any other potential beneficiaries that I can think of will will have these payments coming due, almost like a Social Security or pension payment, except it's a supplement to that, and we totally control it. Now, at 4.5% yield, roughly 4.5, 4.7, 4.8. It's probably about what the latter average is now. Well, what if rates go up? No big deal. If rates go up, I know how to hedge rates. I'll teach you how to hedge rates. You can actually make money when rates go up, even though your bonds are going down. What's the more likely case, and why I'm getting more excited about this, is that if rates go down the way I think they are poised to at the medium to long end, even if it's just for a matter of 6 months or a year, the amount of money that you can make on that zero coupon ladder might blow you away. Okay. It is not out of the question that you could make over a year's time 30 to 40% on a bond ladder, all while the stock market is falling. And I'll skip down to that because that's exactly what I was talking about. Now, look, this is a bond ETF. Okay. This is one of my favorites because it kind of proxies the ladder. And when I'm looking at the bond market and I'm not sure whether the shorter end, with the yield and no price fluctuation, very little, is a good total return, or if it's all the way at the 30-year end or somewhere in between. When I'm looking at that, one way I just kind of say, okay, I'll take one of everything. That's literally what this does. 0 to 30 year, it's 3.3% basically per year in coupon bonds. Not the same thing as building your own ladder. When you build your own ladder, it's different. And if you're not familiar, you can go into the Investors Club sheet and you can see the ladder there. I'm sure I'll be writing a lot more about it if anybody cares. It is my pride and joy. It's the biggest part of my portfolio right now. Don't know if it'll always be, but there's a good chance that it could be for a while. Why? Because once you have that in place, you can then have so much more flexibility, because either you're going to make a lot of money on the bonds, you're going to hedge inflation and still do okay, or you can move parts of the ladder around. I mean, there's so much flexibility. I can't think of a really, really bad outcome unless rates spike to 10% and you didn't know how to hedge. I do know how to hedge, and I can certainly teach you. So to me, it doesn't get more bulletproof, with a treasury ladder, unless you think that the treasury at some point is not going to be able to pay its debts. My belief, and it's not my original belief, is that no matter how bad things get, they may pay us with inflated dollars, but again, you can hedge that too. So I'm looking at the idea of lining up annual payments. They could be quarterly, semi-annual, doesn't matter. A set of payments where these bonds are going to mature. I'm not going to get income on the way, although you can build one with income payments. And anyway, so that's the nature of the bond ladder. And what's getting me excited is that best case scenario where rates fall and now you have a choice. Do I take profits on the bonds, usually while the stock market is not doing that well, which is great, or do I kind of just let it ride and be happy where it is, that I've locked in a lot of that certainty long term. So I take you back here in this week's threes report to I believe that was October 3rd. Okay? When you do this as long as I have, you tend to remember the dates. October 3rd of 2018, through December 24th of the same year. So this was most of the fourth quarter, the same part of the year we're in now. It didn't really get going until December. I will also add that the stock market, the S&P anyway, was up, I think, about 11, 12%, maybe a little bit more when we got to this point. So not too different than the way this year's played out. Same U.S. president, for what it's worth. And I put a link to an article in here right there. Okay. And if you read it, it'll be like, oh, just everything is happening now. Look, I can't map one period from 7 years ago and say it's going to turn out identically. But, history rhymes, as they say. And what happened during that time, because look, I don't see the stock market ready to just roll over and die just yet. But I also, as I noted here this week and have for a while, it could happen quickly, suddenly. Like they say, how did you go broke in the Great Depression? This was the line. Slowly and then all at once. And I think that that's what the equity market's set up for, but I don't know what month or even what year it's going to be. So that's what the offense and defense at the same time means. Might as well just keep riding it up, but be hedged the whole way. That's how I play it. Okay, so look, we had similar to what we had early this year in 2018, down 19% in less than 3 months. And then Santa Claus arrived. Santa Claus's name at the time was not Kris Kringle, it was Jerome Powell. And all of a sudden, they started feeding a lot of liquidity into the system. This was, other than COVID, this was the last of the flooding the system with money situations. I remember one from back in 2016, which kind of looked like this. 2011, always the Fed to the rescue. Maybe it will happen again. Not my concern. I'm just trying to make money based on whatever it is. But look at what happened this is not even a 3-month period, okay? You're talking about a 25% outperformance of a simple treasury ladder, not even tilting toward the long end, which was up a couple points more. 25% outperformance? Why? To me, this could end up becoming the offense. And that's exciting to me because the risk of major loss is a lot less when the bonds are doing a lot more of the work than the stocks. Why haven't you heard that much about bonds in the last 15, 16 years? Because there wasn't a need. But now bonds, rates were so low. Now bonds are really in play as a tactical asset class, and that's what gets me pretty pumped up. It expands the range of things that we can look at to try to make money, because there's going to come a point, I don't know what year it's going to be, but you're going to ask your average investor, and they're going to say, no, do not mention the words stock market in the same sentence, okay? I've lived through this a few times. We'll have it again. I just don't know when. So I'm always prepared for whatever the alternative would be. That's kind of a killer chart, I have to say. You never know, but the last time this happened, 2018, that's about a 40-45% run there, and it took 12 months. And this is in a 10 to 20 year bond ETF. If you use zeros, you get a little bit more boost because they're not paying you the income. All right, take you through the rest of these, go through some of the things with stocks. Oracle has already given back half of this spike, which was not that long ago. Just goes to show you it's happening a lot. Gold, I've done a lot of trading with gold this year, too much to be able to get to you maybe in real time or even close to real time. But the observation I will make here is that's a kind of ugly looking overhang or hangover, take your pick, in gold miners. And I wonder if that's going to lead gold down. I think we'll know sooner rather than later. And the Roar score is once again at 20. And, I explain it here. What does it mean? stock market is too hot to chase with both feet in, but it's yet to show that it's finished rallying. So I made the analogy to it's like having two toes in the water when you have 10 toes. So that's where we are with that. I'm going to stop there for just a second. And before I get to the presentation, I'm going to see if there are any questions. And I will tee this thing up as I do. And look at the chat. Okay, no questions. All right, so let me see if I can put this guy on slideshow mode and slide it over. Okay, notes and all. Now we'll go into slideshow mode. This should help. Okay, we can see slideshow mode, right? I think we can.
Yeah, we can see it.
Great. Hey, Jack's here. All right, good. Jack, you'll like this. This is a different version of the presentation I gave at the Orlando Money Show on last Friday morning. It was a great conference. A lot of good stuff came out of there. Met some terrific people. They do a wonderful job with those things. In my dreams, there will be a Sun Garden Investors Club, shindig, okay, at the site of one of the money shows. Like if a bunch of us are going, that type of thing. Next one's in other side of Florida, but they do the big ones every year in Orlando and Vegas. So there you go. All right. So what I'm going to do is I'm going to take you through, as it turned out, Dana and I were ready, for the presentation, her, the audience, me on stage. And all of a sudden, we walked into the presentation center and all the power was out. They got it back on in time, but I was ready to just, it's just like, whatever, just wind me up and I'll read it off my phone if I need some notes. Anyway, so this is the case for simpler investing. Why simpler? Because there's just too much stuff being thrown at all of us. I see this now as a do-it-yourself investor after managing other people's money for so long. Simple does not mean that there isn't a lot of sophistication. It can be both. And I think that's what I'm going to lay out here, really just in kind of broad brush terms this time around. So this is the path that do-it-yourself investors tend to take. They start out and they're curious. Oh my, I mean, this is rampant. Okay. Now, maybe some of this for some people, I don't think any of the folks in this group, but it's driven by fear of missing out or FOMO. Okay. Hey, I want to get in. I want to get in. Then they subscribe to this or that and whatever, and they, become, dependent on something. Well, then they're not really doing it themselves. They're not paying anybody, or they're paying someone who isn't an advisor, my old job. But they're still trying to figure out, okay, who can they learn from, et cetera. They get to the point where they're informed, they start thinking on their own, they get a little bit more skilled, and then they get strategic. And that's where we all want to be. Confident is okay. It might ding you at the peaks and the troughs in market cycles, but you're still okay. But too much of this is bound to happen, and it will happen in this cycle. Believe me, it will. People will get careless and arrogant. Okay? There's already a lot of arrogance going on right now. It just hasn't been punished to the degree that maybe it will. Okay, outside of an occasional crypto crash or pullback like we had in April, that type of thing. So I think the goal here is to try to move you up the ladder into this range, and that's what really Sun Garden Investors Club and all of my work at this stage of my career is all about. So how do you do that and make it simpler? It's about who, why, what, when, and how. Not words that we haven't all heard, right? Well, the who is really you. Who do you want to be as an investor? The why is, why are you doing this? What is your end goal? What defines winning or success? And I think over what time period as well, because everybody's different. This is basically teaching you to think like a do-it-yourself investor should think from the beginning of the process, whether you have been or not. Okay? Then the what, the when, the how. We talked about this quite a bit in the group, but the what is, okay, once I know who I am and why I'm doing this, that gets you kind of through the philosophy and a little bit of the process. Now I have to start talking strategy. Well, the what is, what am I going to consider owning at a price? So are they going to be ETFs only? Is it going to be just some of them or a lot of them? Am I going to be doing stock screens? Am I going to only buy stocks in the Dow, S&P 500? Am I going to use options? What type of options? There's a lot of that, okay? And that kind of gets into the how as well. But either way, okay, part of making it simpler is saying, all right, I'm going to limit myself. This is more about discipline. I don't mean trading discipline, about discipline to not just chase everything that comes across your screen and say, oh, I want to do that. Oh, maybe I should learn about that. Okay. Learn things gradually, one step at a time, as I'll show you visually in a second. So once you're through this part, it's, okay, what is going to be on the playing field for me? I like to liken this to the sports world. We say, okay, which players are going to be in the organization? They're going to be on my watch list or my roster, my extended roster. Might be in the minor league system and not playing in the bigs right now, but I'm at least going to consider it because you can only track so much and really know investments so much. One reason why I follow the ETFs I do is not because there might not be better versions of the same ones out there, but I know them very, very well. And so I don't have to think on the fly about, oh, wait, what is that again? What does it do? Okay. So that's the what. What is the when? Well, the when is having a mechanism to figure out when something goes into the big time roster or down in the minor leagues. And I call that a depth chart. And then the how, as I alluded to before, is it stocks, ETFs, bonds in a ladder, a good base for a lot of this stuff. Is it options? What type of options? Okay. And it's it doesn't have to be complicated, but I think you have to think through the who, the why, the what, the when, and the how. By the way, you could take notes on this, but I certainly don't think you have to, because there is a written version of this, and we're even working on an FAQ version of this, which is going to go into our Substack site. And so everything I'm talking about here is going to be in written form, almost like where you can query it. Okay. All right. Next. This is kind of the key page to me. It's probably one of the busiest. And if you haven't noticed, I found a way to get the ETF yourself thing back into the picture. I've been looking for a way. This is what it means. Build a portfolio using ETFs by yourself. And it starts here. I'm not going to talk about options, et cetera, in this. I can always answer your questions, but I'm going to stick to the idea, okay, how do you build a simple ETF portfolio? And I'm just going to outline the steps and kind of move through it, and then take your questions on this or anything else today. So I've narrowed it down to 7 key decisions. What is the downside risk? And I'm giving you some examples here. What I'd love to do one week is to have us all gather, and maybe we'll send this out in advance and say, okay, Fill all these out to the best of your ability, what you think you might do, what you can handle, because we're not asking what are you buying, et cetera, but uh, fill this out, and then maybe we'll take some volunteers and I can walk you through it. This is the coaching and mentoring part of all this. So what's your target downside risk? Well, we call it ABL, avoid big loss here. Okay, I will tell you, I am firmly here. Okay, if my portfolio has $100 in it, ain't no way that thing's going below 95 unless I take like $5 out. Okay, I'm not trying to lose money at all, but I'll put up with short-term losses up to a point. Okay, I am not, and this is just me. I'm a risk manager. Okay, in a different stage in life and all that stuff. And I like to think I know what I know about market cycles and things like that. I'm squarely here. I'm not letting my portfolio have more than 5% down year. And will it sacrifice return on the upside? Maybe, but not if you can use options and even a little leverage to try to do that. Okay, I think a little bit more like a hedge fund manager than a lot of people do, and people are welcome to think that way or to expand this out. Okay, maybe it's 10%. Okay, maybe it's 15 or 20. If it's much more than 20, then I think like a couple doors down is where you should be. Go with the gunslingers, right? This is a risk management society here, SunGard Investors Club. Okay, so that's your ABL, and everybody has to figure that out for themselves. How much time am I going to spend on it? Well, it could be any of these or something else. How will I decide when to make changes? Well, my mechanism is the Rohr score, but it's not, it can be as simple as SPY and bill, but obviously, as you've seen in some of the stuff I built for you, it can go deeper than that. That said, also, there's a conservative version of the Rohr score. That's the original one. There's the moderate version where I force 50% to always be in SPY, and then I allocate the rest with Rohr. Then there's the aggressive, which is as aggressive as you want it to be. I literally was tooling around with something today where I said, what would happen if I applied the Rohr score to a 2 ETF portfolio where the offense was SPYU? What is SPYU? It's the S&P 500 with 4 times leverage. Been around a couple of years. And what's my defense in that case? Well, how about UVXY, which is 1.5 times the movement of the VIX. So in other words, when the market really tanks suddenly, that thing can go up hundreds of percent, almost like a put option. Not quite, but in the direction of a put option. And so I'm always experimenting with, hey, do you need more than 1 offense, 1 defense, or 2 offense, 2 defense, or 5 of each, or 10 of each, or 15 of each? I probably have 100 ETFs I look at on a regular basis. Realistically, there's probably, 10 to 15 that I'll consider on offense or defense. And look, for some people, it's as simple as, see, these columns don't line up. It's just that I came up with sort of a spectrum for each. Okay, you can go with a simple 2 ETF portfolio. It's always SPY and bill. You can say, oh, you know what? I'm going to go with a little more moderate version of that. Or I'm going to apply conservative or moderate, but I'm going to have, sometimes I'll be in SPY and sometimes I'll be just in the equal weighted SPY, RSP. Or for the defense, I might be in T-bills, but if T-bill rates really stink, maybe I'll have some other alternative. So it's a lot of building here. And the goal ultimately for us is to actually build a toolbox where step by step, hopefully with your input, we'll be able to build a portfolio maker. Okay? Which ETFs will be on the watch list? Okay, this is about research and selection. Well, you've got T-bills, You got bonds, you got stocks. Well, those are the big three. Okay, sure, you have commodities, things like that. You also have inverse, and you can have leverage. You can even have inverse and leverage, minus 2 times, etc. So it all depends. But the idea is to bring yourself up the learning curve. That's why I showed you that chart with the little mountain. How many ETFs will you own at one time? Well, that's kind of that depth chart that I talked about. Chances are it's not just one, okay? But it might be as few as 2 at a time. Maybe it'll be 3. I've worked on some models where it was SPY, Bill, and VIXI or something like that for that disaster protection. Okay, take very, very, very small position, but it's kind of like that additional inverse position. This is all up to you. I'm just having a conversation with myself at this point about different ways that I've done this in the past. This is what I did for a living for the better part of 30 years. It just wasn't with all ETFs. It was mutual funds. Sometimes it was stock exposure, options, etc. But ETFs kind of became the center building block for these portfolios. I think that we go up to 6 in a portfolio, you go up to 20 in a portfolio. But again, it comes back to how much time do you want to put into it. All right. And then along with that, it's a little bit of a byproduct of what else you do, but position size ranges, okay? If you do have 6 ETFs in the portfolio at any time, well, are you going to let one be 40%? This is not that big a deal to me because you can always hedge. I could literally say I could put 95% of a portfolio in the SPY, and then for the other 5%, I could, let's say, go between 1% and 5% in one of those VIX ETFs so that I'm good even when the market tanks, and it will slide a little bit. I mean, there's an infinite number of ways to do this, so I don't want to get off on too many tangents here. But to me, this is like a control sheet, okay? It starts with this very broadly. That's the control sheet. And I expect to keep going back to this because I've been going back to it in my own portfolio work, constantly for 30 years. Okay, so then of course ROAR. If you haven't seen it this way, it is in the shared doc. I'm starting to use these expressions a lot more now in my writing. I'll be writing a bit for Seeking Alpha and Bar Chart about this too. But right now, you got a lot of things that are stretched. Okay, they're not rolling over yet, but they're stretched. Some. So, for instance, that chart that I showed you of the S&P is still in stretch. So is the Nasdaq. So is the Dow, which made a new high today, which only means it was lagging up until now. Not that it's some reason to celebrate, although I'm sure the headlines will scream. GDX, as I showed you before, kind of in that fading rolling, and it gets a little bit worse. It'll be in full-fledged descent, or maybe worse. Now, what I struggle to find, or at least I have in the last few months, you can find things that are showing signs and things that are an uptrend or sweet spot. But you know where I'm finding these things? I'm finding them in my short-term trading stuff. Okay. Let's see. Recent examples. Coke up, I don't know, 3 or 4% today on earnings. I took a little trading position in Coke, I don't know, a week ago, a few days ago, something like that. It probably already, I've already cut it back a bit, might cut it out any day now. That's all this is. Just taking the same ROAR approach that we talk about for strategic investing and applying it to a very short time frame. Another example, I found Cleveland Cliffs. Great looking chart. Looked at least in an uptrend, maybe in the sweet spot. Poof, earnings yesterday. I didn't know what the earnings were going to be. Stock was up, I don't know, 17, 18, 20% yesterday. Sold it. And I'm like, I'm not that, there's plenty that go down as well. But my point is, I'm starting to see that the more information I can get out to you about what I'm seeing over short time frames as well as long. I mean, think about it. Before you get to actually, before I get to the point where I say, oh, wow, it looks to me like the S&P is going to really have a rally here. We're going to go up 10, 15, 20% next year. I do not believe that right now. But if I ever got to that point, it's probably going to start with a very short-term chart, and then it's going to keep going. That's what happens. It starts in 1 hour, 2 hour, 4 hour. Then it bleeds into the daily in a good way if it's to the upside, and then a 3 day, and then a weekly, and then before you know it, you've got a secular bull market. And it works the same way on the downside. Right now, you look at intermediate term time frames and you've got nothing. Okay, you got a lot of this, and that's why the Roar score has been at 20 for 3 months. So uh, we're updating this regularly. I'll have actually a little more news on this next week, I think, because I think that automation project is finally done, where effectively there's a version of the simple Roar score, the moderate and the conservative, that can basically operate without me looking at it. We programmed the closest proxy that we could, and I'll start to show you where that lives and what it looks like. Meanwhile, human Roar is doing okay. Since 2022, when I started doing this with my own money, we're about 8-9% above what I consider to be the benchmark, a conservative portfolio, because this is a conservatively minded portfolio. But again, it's just spy and bill. And I'm going to start writing a little bit more because it's been almost 4 years now, and it's been a very key 4 years with the bonds and stocks going down at the same time, and then the calamity of this thing and not breaking and all that, and the Roar score being somewhat anticipatory and defensive. I think it's perfectly suited to make the case for everything being simpler. If you can do this with nothing but spy and bill, imagine what you can do if you just said, okay, I'm going to pick, I don't know, 6, 7, 8 ETFs and create what they might call a permanent portfolio out of it, where I will always have allocations to some major market areas, but I'll use the Roar score to handle the allocation. Okay? That is an area that I'm also pretty interested in. It's one of those kind of like to have, not have to have. This is the have to have. Because if you can let your mind's eye go to the left of this and block it out, and you just go from here forward, I don't know if you see it. That's about as straight line of return as you can get. How did I do it? Charting SPY once a week with the Roar score and assigning it between SPY and bill. So in a very inflexible, hands tied behind your back, okay, it's like managing money in half a straitjacket, and it still has run up at about an 8% straight line return. Now, that's the past going forward, but I'm talking about the process, not the performance, and how there's a lot of funds and a lot of investors, probably a lot of hedge funds, frankly, that have not done nearly this well and fell prey to every market decline and did not take advantage of the fact that T-bills are still in the 3.8 to 4.2 range and have been in the 4% and above for most of this period, which is part of the reason this can work, but it doesn't have to be that way. And just quickly, the other version, the moderate, also doing quite well. I hear all this about, I mean, there's entire conferences about what to do about the 60-40 portfolio, and financial advisors are gathering together and they're having money managers come up and, well, should you make room for alternatives, like private credit? What could possibly go wrong having mom and pop invest in private credit with deals that the institutions can't buy enough of anymore, so they're trying to give it to the little guys. I mean, this stuff makes me pretty angry. uh, Part of how you know it's a bubble. And look, same type of thing. It's got a little bit more give because I'm forcing it to be 50% SPY all the time. But again, fairly inflexible, but using the Roar score mechanism, which shows me that, I mean, charting the S&P 500 is one of the most important things that any investor should learn how to do. And then you can always add pieces beyond there. Okay. Definitely not going through this, but it is in your sheet. But this is kind of how it looks, as you start to bring it together. Is it SPY and Bill? Is it SPY and Friends and Bill and Friends? Okay. Uh, and that would be what I call tier 2. And then you ask yourself, okay, how many of these am I going to use? Is it just one instead of SPY? Is it SPY versus one of the others, or do I use multiple? Same thing over here. You can get as detailed as you want with this. That's the key. So I am going to stop there. We've got a couple questions, and I'm going to answer those, and then we'll continue on and then finish up. So let's take a look at the questions. Knock that off the screen. And let's see. First question. Time to roll the SPY put. So you should know that, and I mean, I announced this, not the Rob's active portfolio is, effectively I'm managing everything so actively at this point that there is no one SPY put. I mean, I'm constantly managing around it. And I'm a bit more Qs oriented than SPYs oriented these days, because you get a little bit more volatility. And I'm finding that if SPY does well, Q is going to do better. And so, in terms of rolling the put, it's a personal situation. What I've started to do a little bit more, because look, I mean, I'm a scientist with this stuff. I've started collaring the Qs, but with the idea that I will vary the position in the Qs up and down, so in multiples of 100 shares. And I'm definitely owning put options below, but I am also selling covered calls, but I'm doing it more actively because I'm trying to see if I can turn on a bit of an income spigot by doing that. Because again, I've been railing against the covered call ETFs because they don't protect the downside. Well, if I protect the downside, let's call it a little bit more passively, a month or 2 or 3 at a time, with the put buying, and I am more active managing the calls, I mean, I'm bringing in a lot of income for the limited amount of time that I've been doing it. You should also know that there is another theory that I am testing, and you guys see all the research first, so I'll let you in on it, and I'll probably write about this for somebody fairly soon. I am wondering if one way to get at this idea of collaring Qs or SPY instead might be to own the Qs as a flat amount. Let's take round numbers, even okay, even you can't do it in 100 share lots. $100,000 in the Qs. Well, what if I had as much as $100,000, but maybe as little as, I don't know, $50,000 in PSQ? Yes, they do opposite things. Okay, although PSQ has a decent yield because it's mostly T-bills. So, but it shorts the Qs. It gives you a little bit of yield net net. You can mess with the short position or the inverse position a little bit, but you got the Qs in there protected as fully as you want to be. And that now gives me the right to write covered call options on the Qs. And if the market just keeps going up, up, and up, and I see that in the chart, I can lower the PSQ. In other words, I'm still avoiding big loss, but I'm generating more income. I've run this by a few people, I think including one person on this call. And I've run it by a couple of my editors who have options experience, and nobody has said, no, this is a terrible idea. So I'm going to put it out there for public consumption. And so that's kind of what I've been doing in Collarville lately. Okay, let's see. VIXI decay. How long should I hold a position? Well, when I model this, I model it with daily rebalancing. Okay. The other thing to keep in mind with some of these VIX ETFs is they originally were built wrong, and the people who built them realized that after a while, and so they ended up reformulating them, and I think they work a bit better. But let's not kid ourselves, okay? Uh, I mean, you're talking about something that just this year, okay? Well, forget this year. Let's see. That's a round trip starting February 19th when the market peaked and ending on July 24th, okay? So in a 5-month period, VIXI went from 40 to 88 back to 40. Okay. And if you look at UVXY, which is the same thing, but it says 2 times, but I think it's closer to 1.5 times. All right. What did it do? 17 to 52 back to 17. Okay. I guess you could have a lot of fun trading this thing if you had the patience. Okay. But let's keep this in mind. All right. How much do you need of something in your portfolio so that when the market goes haywire because all the tariffs are back on and they're tripping, or something happened in the economy, or the Fed lowered rates by a point because they had to, because all of a sudden we're in recession, or the government can't function, everybody's selling treasuries, whatever. Make up your own. Doesn't matter what it is. If you have something that at the very worst possible time can triple in value, triple, okay? Kind of like it did here too. What is it? 2065. So it tripled once this year, and it tripled once this year. And if I went back a little bit further, I'm sure in 2020, pandemic starts. And again, they messed with the pricing here, but whatever. 53, yeah. So that looks like it was about a 6-bagger. Okay. So when you have something that is that powerful, 2 things. First, interesting alternative to put options. Second, you better not put much money in it, because it can give it all back just the same. Okay. Because you've got leverage and you've got volatility index. I mean, it's like leverage on top of leverage on top of leverage. But as far as I'm concerned, remember what I say, take big shots with small amounts of money. The reason I like tools like this is that it allows you to use an ETF to do what you might do with options. And remember, options can get very expensive very quickly when volatility spikes. And here, you're kind of there for the ride. You just have to be, a little bit hands-on with it, I guess. Okay. But the best thing for me is to use something like this, or a VIXI, or there's even a softer one, VIXM, which I've used as well. What did that do during all these spikes? Let's see, from 15 to 19, 20. Okay. Yeah. Let's see. Actually, it was a little bit lower. Yeah. Yeah. So it went up to 35%, something like that. So it's a lot tamer because it goes out a little bit further. It's not like the near term contracts. But look, all these, okay. Same thing with levered ETFs in both directions. A little bit of something that is anti everything else in your portfolio from a concept standpoint, that can be very powerful as a defensive mechanism, and it saves you uh, some worry that you're going to wake up one morning and market's going to be limit down, as they say. Okay. You could also look at it as, I can put on my my big boy pants, as we used to say. Okay, and I can be more aggressive if I know I have some of this. As far as how you rebalance it and all that, obviously personal decision. But what I would say is, uh, you don't let it get too far. A 10% move on this thing can be all in a day's work. So you probably have to manage it a bit. And maybe it's as prudent as saying, okay, I'm not going to rebalance it necessarily every day, but anytime the position changes, if I put 2% of my portfolio and it is a disaster hedge, and now it's up to 2.5 or 3%, well, maybe I should knock it down. That's a whole nother discussion, part of a portfolio construction discussion. But I feel like these things, I mean, look, you also have to look at it as if you're buying something like UVXY, okay, what's your worst case scenario? You buy it at 10.56 a share and you sell it at less than $1, okay? You put 10% of your portfolio in this. Don't tell anybody that I told you, because I never would. This is like a 1-2% kind of thing. I mean, think of it like an option. It doesn't expire per se, but it'll make you perspire. All right. So let's see. A downside risk tolerance. What time frame do you use? Like, you don't want to see a daily decline of 5%. Well, to me, this is going back to the subject of risk management. So, I mean, for me, it's it's any point to any point. So, um, if well, I'll just pull up. Oops, pulled up the wrong one there. That's the crazy one. Okay. All right. So again, let's just say this were portfolio value. Okay, if this is my portfolio value is $671, well, some people have stop orders, which, as I've told you a million times, don't work. Okay, at least not when you want them to. Boom, there's 5%, roughly speaking. If I'll probably make a mental note. All right, and my clients back in the day when I was an advisor used to do this all the time. They wouldn't think in terms of percentages, but they'd say, "Oh, I have to stay above $650." Okay, we're at 671. Yeah, is it going to go below 650? I don't know, but it's good that we noted that, Mr. and Ms. Client, because I'm going to have that as a target. So uh, this would be kind of my limit. If I get down to here, at the very least, I'm having a discussion with myself and I'm putting some type of massive risk management on beyond what I had. But it never should get to this point, is my point. With all the tools that we have and the Roar score, etc. If you lose more than 5% from peak to trough, is because you are managing risk not at all or reactively. And I think the idea is managing it proactively. And the best way to show you what that means with a very recent example is this. Okay. Yeah, I've been trading gold. I collared it for a while. I do this back probably when I was still in it in a collared format, and then I was like, the heck with it. They're just bidding it up every day. I'm not going to get the thing called away from me. Every week. So I started buying some call options, and maybe a little bit of put option. When we started to get up to here, I still had the call options on. I kept rolling and rolling and rolling. Okay. And then I started saying, you know what? Let me take some of these windfall profits that I have on GLD, and just in case, let me put something out there. I think it was a couple of days ago, and I believe that 380 was my strike price when it was selling around 390 something. Like, I mean, it's somewhere between dumb luck and proactive exploitation of a monstrous pop. Might be a 1 day deal, but I only needed 1 day to make 100 something percent on a very small option position. But I'm trying to get in the habit of doing this because I'm finding these things in the charts all the time. It all goes back to the charts. It does not have to do with whether China's buying up the world's gold supply or whether the Oval Office has gold all over it, or if people are debating between gold and crypto, which is better or whatever. None of this matters to me. I look at the freaking chart the way I have for 40 years and over 100,000 hours, and I've turned it into a mechanism. The Roar score is that mechanism in a simple format, but it can be applied to anything. This is what I would call stretched. That was a 40 Roar score, folks. Okay, what is it now? Well, I would say it's a 30. It's fading rolling. It's not crashing yet because I can also, with my eyes here, kind of amazing. This is a weekly chart. I mean, a daily chart. Okay. Well, that lines up pretty well. Hey, why did it go all the way down to here and bounce? Why? I think I just came up with my next article. Why? For all the people, and I'm talking to those mostly seeking alpha audiences, technical analysis, whatever. Okay. I wish somebody had a contest, like how many jelly beans are in this jar kind of thing. All right. Because uh, based on this, before today, I would have drawn the line right where it is. And it just so happens that it lines up with exactly where this thing went to. Why? My dad and I used to be among the small number of voodoo artists, AKA technicians, okay, as far back as the 1980s. Today, lots of technicians. And it's not the people as much as it is the machines, the algos, okay? You've heard about quantitative trading and AI based whatever. They're using this. So to say, well, I don't know, gold has the fundamental situation with gold and versus silver, and look at this ratio and whatever. As we like to say, just show me the chart. Just show me the chart, and I'll evaluate the risk and the reward. And I won't be right every time, but I count on being right enough and when it matters. Okay, let's see. It sounds like a good way to hedge an index and retirement plan with no access to options. I would give you a standing ovation, but then you'll just be seeing my waist. I'm pretty tall. So that is a phenomenal observation. One that has been made here before, but we can't make it enough. When all you have is SPY bill. Let's see. Do I have it in here? Yeah. No. Yes. Here we go. Okay. When all you have is SPY bill, well, you can have access to that in a 401k plan. So why not take, you got an S&P 500 option and you got this. I mean, even if they only allow you to reallocate every quarter, there hasn't been demand for it yet. If I had so many people say to me, we're subscribing to your Substack, or we're joining this group, and we'd like to be able to have you do a monthly or a quarterly version of the Roar score, so we can reset our 401ks. I would do that in a heartbeat. but I can probably count on one hand the number of people that have asked for that over the years. So yeah, we continue to do the weekly. Yeah, I'm sure you can work it out either way. So that is perfect because they just don't give you a lot of choices there, and it's simple. You can also adjust the Roar score and say, hey, you know what, I don't want to be a 20, but maybe I don't want to be all into the market all the time. Let's see. When would you have sold VIXM when it last peaked? Well, remember, I don't look at these in isolation. So, uh, VIXM, and I will say these do not behave well with the charts. Okay. When I chart VIXM, I should say I'm not really charting the VIX ETFs. They're all based on S&P 500. So when it's really more the question of when would I increase or decrease a position. Okay. If anything, you can graph the VIX, but again, it's very dicey. Okay. I mean, I can see it was forming a bit of an upswing here. Probably more around here is when I entered. The problem with this thing is it's done in a heartbeat. So I always have to go back to, remember, it's going to correlate exactly with the S&P 500 just about all the time. Why? Because VIX volatility spikes when the S&P goes down and it falls back down when the S&P goes up. Now, the other thing you can do is look at SVXY, which is the opposite, unlevered, I believe, but it's the opposite of VIXY. Okay. I have tried, but it's too squirrely. It moves around too much. I have tried to run a portfolio where it was as simple as I put a lot of money into T-bills and I put the rest of it, or and well, right? You could take the existing Roar score, SPY bill, and if I put a little bit of SVXY and a little bit of VIXY around it, it's almost like put and call option. Okay. This to me is like a surrogate. It's an option version. I'm sorry, an ETF version of a call option. And this is like an ETF version of a put option. They can be used together because if, let's say, just simple math, I have 1% in each of them. Well, one of them could double in value in a violent market move in one direction or the other. The other is probably not going to lose all of its value. So there may be some arbitrage there. So anyway, I don't want to go too much down a rabbit hole, but these are good questions. I'm trying to give you a sort of generic answers, but now to me, it's I'm not trying to time tops and bottoms. I know that people think that everybody in the business is trying to time tops and bottoms. I am looking at it instead, just like with the Roar score, and I'm saying, okay, should I be positioned like if somebody said to me, "Do you like the S&P 500 here?" Yes, 2 toes out of 10 like the S&P 500. The other 8 toes want nothing to do with it. That's why it's a 20. And it's obviously it's a calculation and a visual and doing it for a long time, and now automating it. But that's what it all comes down to. It's less about would I buy or sell VIXM as opposed to think of it as something like VIXM might be the third wheel in SPY bill VIXM, SPY bill VIXY, SPY bill UVXY. So you've got your equity, your cash, and then you've got your uh, major market move defense or exploitation. Okay. I think that is all the questions. Are there more? All right. Any feedback? Any um, thoughts on what was useful today? Feel free to use your microphones because we went over the threes report and then we went over the presentation. And there's a lot in there, but I tried to keep it at surface level today. Any questions? All right. See you next week.